Hey there, everyone. Dave Keller here with Market Misbehavior, and welcome to the latest episode of our Market Misbehavior podcast. Our goal with the Market Misbehavior podcast is to sit down in person and often virtually with top market practitioners, money managers, strategists, technical analysts, and top investors, and just pick their brains in terms of what they're seeing and hearing about the current market environment, how they're applying their toolkit and how their toolkit is evolving over time, how they use some of the tools of technical analysis and behavioral finance in their decision making, and what sort of opportunities they're seeing at any particular moment. Today, I'm going to share with you a conversation I had recently with John Kosar. John is a fellow CMT, and as a matter of fact, he actually sat on the board of the Market Technicians Association before I did, and was a mentor of mine, certainly as I got more involved in that organization back in the day. John's based in the Chicago area, and he runs a firm called Asbury Research. Asbury Research started almost 20 years ago. With applying his experience working with institutional investors and creating a retail-oriented product. He's recently added money management capabilities and works for individuals as well as institutions and financial advisors to help them better understand the markets using a pretty well-defined technical and asset evidence-driven toolkit, as I would describe. My conversation with John touched on a number of things. We recorded this right after the U.S. Elections, less than a week after the elections were confirmed. So we talked about the market outlook post-elections, what sort of trends we saw emerging out of the election night. We talked about his Asbury Six market model, and as I've interviewed John over the years, I've always found that is a really interesting way of just quickly illustrating a macro model combining technical, more asset flows, sentiment, volatility, all of those things play into this macro model. Firing on all cylinders when I spoke to John recently. Talked about sector rotation and emerging leadership. We focused in on the technology sector and talked about the Nasdaq, talked about the software ETFs. I asked John about how he selected which ETF to actually pull the trigger on, especially in a space like technology or software. There are a lot of different ETFs you could select, and I thought his answer was actually really thoughtful. And we finished off talking about money management related to the challenges, or I guess the differences between managing money using technical analysis and just analyzing charts using technical analysis. And I thought he had some really thoughtful comments there as well. So please enjoy my recent conversation with John Kosar of Asbury Research. All right, so we're sitting down today with John Kosar of Asbury Research. John, it's been so fun to interview you over the years, and I'm super excited to interview you now on the new Market Misbehavior podcast. So thanks for joining me.
It's great to be here. Really looking forward to doing this with you.
So the market's obviously at a fascinating sort of point in market history. I feel like we could have said that many times here in recent years, but especially now, right? We've had that, Trump bump, that initial spike higher after the elections in early November. Just kick us off looking at the overall environment. Now that we've had sort of this big gap higher, you have the S&P briefly trading above 6,000 last week for the first time in history. Do you, looking around you in early November, see signs to be optimistic, signs to be concerned, a mix of both? Like, where's your head at after the rally that we've experienced here recently?
Well, it's kind of a little of both, but more of the former. I'm well aware. What are we up? 48% year to date. And I don't even know what we're trailing 12 months. I think we're up something like 46-48%.
Yeah. And
for the year, everybody knows it's just been straight north. The average, I think the 5 or 6 year average for the S&P 500 average annualized return is probably in the 12 to 14% area. Yeah. So way overstretched. But more important is, what's the market doing right now? Trying to anticipate that there's a top because the market's doing something atypical is a way to lose opportunity. And this has been a very opportunistic year.
Well, and I was going to say, and if you've not participated in these rallies, that's where I've often told people, right? Like, the most uncomfortable position you can be in as an investor is being on the sidelines and just watching things appreciate. And so, right. So generally, I mean, the market's been trending higher. I do want to get to, because your Asbury Six, I've always really enjoyed talking to you about that sort of macro model, looking at different types of metrics and what they're showing. Talk to us about what your Asbury Six model is showing today, and what does that mean for risk assets here?
Green is good, right? So everything is green. Basically, I built this model. My son Jack and I actually built the first couple of iterations of this, and we kept it in-house, because even as a guy that's been doing this all of his life, when you get up in the morning and the S&P is down 60 in futures, and then by noon it's up 50, I don't care how long you've been doing this, it really can knock you off your game. It could make you wonder if you missed something, so now you're going back over your charts and you're wondering, okay, what did I miss? You didn't miss anything. The market is more noisy now. So I needed something to keep me looking at, let's look at these as the 6 cylinders of a car. Are you hitting on all 6 cylinders or not? If I'm 4 or more green, which is a positive bias for the model itself, I'm going to look at that down 50 in the morning, and maybe even if it opens up down another 30 the next day, I'm not wondering if I should start to pare back my exposure to equities. I may be looking for places to buy, or I may at least be looking at where the support level is that the market may need to hold underneath. It keeps me on my game. Right now, all 6 of these are green. And if you look at those numbers inside those cells, a lot of 11.5s and 11.6s in there, right? That was, we opened up 130 higher the next day. The Asbury Six was 5 of 6 red going into the election. And that huge, but the 5 of the 6, they were kind of borderline, right? There wasn't any that was extremely negative. They were just kind of tilted that way. And the election came out, everything snapped back to green and stayed that way.
And your model, right? It's sort of binary, right? It's either positive or negative. There isn't a neutral setting. Arguably, probably some of those would have been neutral if there was a neutral setting, right? Right before the elections, I would guess. Yeah,
the neutral would be 3 and 3.
Yeah, right. Okay.
And that happens sometimes. And sometimes what'll happen will be all green, and then you'll start to see 1 turn red, 2 turn red. Now you're 3 and 3, 3 green and 3 red. The first thing I do is go to the chart of the S&P 500 and see if we're on a support level, because that 3 and 3 is kind of, if your scales are balanced, right? If you could think of a scale and you've got 3 chips on one, 3 on the other, and they're both level, that sometimes gives you opportunity. And we all know the market goes up most of the time, right? So the stock market game is not, should I buy, but where and when should I buy? So sometimes when we're at 3 and 3 and we drop into a support level, I know that I can add to my position and risk this much to have an open-ended upside. So that's another thing that this has a pretty good use for.
I like that. So this is sort of running in the backdrop, right? Sort of giving you a general sense of the market conditions. And then that quarter, I guess, sort of informs how you would be interpreting some of the tactical movements or the short-term moves. So going through these 6 metrics, right? It's the rate of change of the S&P. So basically the trend in the S&P, stocks versus high yield bonds, asset flows, which you've often talked about flows around ETFs, which I think is a brilliant way to think about, risk and I guess asset rotation, volatility, volume, market breadth. As you mentioned, all of these now bullish right after, sort of at or right after the election. When you look forward, if we're nervous about how things are going to go between now and year end, what would you be looking for? I guess what we'd probably be looking for is some of these greens start to turn red. But is there a particular area of the Asbury Six that you think would be most vulnerable, or that you would tend to look for as like a signal that maybe this rally is not sustainable? Or is it simply look for the negatives to outweigh the positives and be patient for that moment to arrive? How would you think of it going forward?
I don't really weight these because the reason I picked them is because they're pretty disparate. They're all different. And we all know that no indicator works all the time. Yeah. So I almost look at this as like a hockey team of six players. And if your center falls down, one of your wingers will come up and pick up that check or whatever. That's kind of how this is in the market. So you might have 1 or 2 of these that are not working right now for whatever reason. Those other 4 will pick it up, and they're different enough that it gives you a pretty comprehensive, very tactical look at the health of the market. The one that's the most negative and the one that normally turns first, especially in a situation like this, where the market's up, whatever it's up for the year, we're getting towards the end of the year, it's full tilt boogie, everybody's buying. The first one would be the VIX, typically, right? You get that spook in the market. Something happens where CPI comes out the wrong way tomorrow. And all of a sudden everybody's, wait a minute, I'm way over my skis now. And this is the first place you'll see it is the VIX. But then you need 2 or 3 more to tell you that it's more than just a one-day scare in the market. And that's where this comes into play.
Yeah, and the VIX obviously had pushed above 20. It was sort of a bit of a warning sign, right, going into the elections. But then post-elections, it's dropped right down into sort of the mid-teens yet again. So we're sort of back to a relatively low volatility environment. I mean, that's super helpful. And I think there's a lot to be learned from just how you are sort of aggregating all these different inputs. And thanks for a hockey reference, right? A rare hockey analog for the markets. I love that with hockey season. We're getting into it pretty good here. Another model that go ahead.
There's just way too few synergies between hockey and the stock market. And I think it's our job to try to get more of those into play.
John, you and I will explore this as a Kraken fan. I will definitely embrace that with you. We'll see what we can do. Your CEF model is really looking at sector rotation, and I think there's been a lot of attention, certainly going into the elections, a lot of speculation about what sectors could or would thrive under different administrations. Now we obviously have an overwhelming, Trump win in the elections, and more likely looking like a Congress that's going to be supportive of things he's trying to do. And so certain areas of the market now you're seeing, sort of emerging from last week and starting to differentiate themselves. When you're looking at flows around the sectors, what are you seeing now? What does that tell you between now and year end? What should we be looking for?
This has been our back test on CEF goes back to the middle of 2018. So we've got about 7-ish years there. This year has been the most atypical year that we have had so far. And it was atypical in the sense that the rotations were extremely quick, violent. Technology, it's number one this week. Basically, the lowest score, or if you see we have 1, 2, and 1 here in technology, that means the acceleration of assets going into technology by the the formula, the methodology that we built. It's going into technology fastest in the trading category, second fastest in tactical, and first fastest in strategic. So that means there's a rush of money going into technology in 3 different time periods. But what's been happening all year, technology will be number 1 or number 2 for a week or two. Then it'll drop to the bottom 3, and utilities will float to the top. And then something will happen and they'll flip back again. So you've got all of this tumult churning. So Jack and I, Jack's my son and he's my partner who backtests all of these different models that we build. So we just literally did this morning, trailing 12 months, despite all of these quick turns, where the top 3 are right now tech, financials, and XLY. And then there's just been a lot of rotation. We're right even with the S&P 500 with 30% less risk. So the model, I'm shocked, frankly, that the model has been robust enough to be able to handle all of these flip-flops in terms of what's in favor. Bigger picture for what we're talking about today, that indicates to me that even though the market's been strong for most of this year, internally, managers don't know where to be. So I think you see technology and XLY one week, and then you might see staples and XLU the next week. Everybody wants to hedge their bet. It's kind of like musical chairs. Nobody wants to be overweight all these fast horses at the top and then have the election happen and the bottom fall out. So now that the election's behind us, I'm thinking these rotations are going to be a little bit more sticky going into the end of the year.
Really interesting. And you and I both spent time working with institutional investors in a strong bull market like this. It's remarkably difficult to outperform the S&P 500. It's a challenging environment, and especially trying to predict what stocks are going to do well when the market itself is so strong. It feels like everything is going up.
Yep.
Is a challenge, and the churn, as you mentioned, has been very real. So with technology at the top of the list, let's talk about the Nasdaq Composite. When you're looking at sort of the pure technical configuration after what we experienced sort of going into the election, now coming out of the election, what's sort of your expectation going forward? Where do we go from here?
Great question. The one great thing about this business is the longer that you're in it, the better you get, the better you get, because you're learning things all the time, and you're discarding stuff that doesn't work for you anymore, and you're adding new stuff. So one of the ways that I think I've kind of gotten better, I've kind of evolved, gotten smarter. You think after 40 years, right, you should be pretty good at this. But what I used to do before is I used to use the price charts to initiate the idea. And now what I'm doing is I'm looking at more quantitative stuff to initiate the idea. Asset flows, relative performance, breadth, things of that nature. And then I'm going to the price chart to manage my expectations. So that's that chart that we have showing right now. And that's showing that the comp, which is the larger of the two Nasdaqs, the one with more stocks in it, the way that markets trade is we have big long trends, and then the market starts to feel, which is the market is the aggregate wisdom of all people with skin in the game. So up here, a little bit over its skis, market backed off, stopped right at the 200-day moving average, which is the orange line indicating that the major trend was still intact. We had more sideways churn, and then we broke out of there. It's called a symmetrical triangle. It's a very kind of it's TA 101 stuff, right? It's just a simple pattern, but this pattern points to 20,250. That's 5% higher than where we were at the open this morning. So I saw what I would call more quantitative stuff, money charging into the queues. My CEF model was pointing me towards technology in the early part of September. This manages my expectations. So somebody says, "Oh, how high do you think it can go?" Well, it can go to 20,250 or maybe higher, but we need to hold the support. Where's the support? It's at the July the 11th peak here at 18,671. So now you can overlay some risk reward on your idea.
I like that. So it's developing an upside target based on this sort of congestion area or indecision, right? The symmetrical triangle that you mentioned, and that measures further than we've been so far. One of the ETFs that you'd pointed on in particular is IGV. This is a software ETF, I think, right?
Yes, software ETF. The reason I showed this is I was gonna kind of show you, because I mentioned the way that we find, one of the things that we do is we pick shorter term trading opportunities in ETFs. So we look at about 6,500 ETFs or something like that, Jack. So we scan them, 6,500 ETFs every day, and we look for three things. I want to see trend, I want to see relative performance, and I want to see asset expansion. So, and we have certain criteria, home cooking kind of stuff that we do, but we have certain in-house parameters, how we define trend, how we define relative performance, how we define expansion. Once we get those three things, we get a list of them first thing in the morning. Sometimes there's 50 of them, sometimes there's 10. But then we look at those, and the only subjective part of that is we look for risk reward. And you can see here on IGV, 21-day moving average over the AUM, and IGV is the center chart. So on September the 10th, we had monthly expansion in AUM. Down here, this is relative performance of IGV versus SPY. That was October 4th. Why do I do that? Because to me, if you're not outperforming the S&P, why not just buy the S&P and have the entire index? So if it's not outperforming the S&P, have the safety of the shock absorbers that you have when you have 500 stocks instead of 20 or 25 stocks you might be here. So the third part is the risk reward. And up at the top, after we broke out of this pretty strong resistance level here, now I've got something to lean on. I've got trend, I've got asset expansion, and I have relative performance, and I can lean on this 88, 82 level. So I'm risking this much to make that much. And that process you go over and over and over again. And I've been doing this for 20 months now. We've had 81 trades. 57% of them have been profitable. And my profitable trades are 2.5 times larger than my unprofitable ones. So the reason I'm bringing that up is if you're building a model where you're going to pick stocks or pick ETFs, two things have to happen. You have to have more winners and losers, and your winners got to be bigger than your losers. And then if you have those two things, it's just in degrees how much money you make.
Right. It's a really, I mean, that's a beautiful example, John. Thanks for talking through those three components, right? Looking at trend, looking at asset expansion, looking at relative strength. I think that's a great takeaway for people trying to make sense of where opportunities could be and trying to identify them. I'm curious when you're thinking of something like technology, right? If technology, it scores pretty well based on asset flows. When you're looking at the Nasdaq, how do you determine what lever to pull, right? What draws you to the IGV particularly versus, in technology, right? Yes. As an example, you've got a bunch of different things you could buy. What sort of helps you decide which ETFs to pull a trigger on and why?
That's a really good question. And the question is, so we'll do a scan and I might get 6 stocks that are all in the technology space. So the first thing that I do is I run a linear correlation. We use a Pearson coefficient, a simple Pearson coefficient. And I want to know if those 6 stocks that I found, if they're all effectively the same stock, right? Because they're linearly correlated to each other. It's very easy to say, wow, these 3 stocks look terrific. And you just bought 3 of the same thing. So we have to make sure that we're putting on positions that aren't the same one. And then the part of the question that you asked is then it's risk reward. So that chart of IGV, I'm going to look at that chart and say, okay, if I buy that breakout that was on the other side of that line up here in the top panel, what's my risk? So I might have 3 ideas and 3 disparate ETFs, and then it's going to be one of them I have to risk 4%, one of them I have to risk 8%, and one of them I have to risk 12% in order to keep the trend intact. So I take the one with the smallest risk because that's going to increase the risk to reward, which has given me 2.5 times larger winners than losers. That's how you create that, by finding 5 or 6 that are all good buys, but which one can you do the cheapest?
Interesting. That was awesome, John. I really appreciate you talking through that. That's actually really, really helpful. One last question, John, then we'll leave it there. You have been running Asbury Research for a while. How long? When did you actually launch Asbury Research, by the way?
I launched it in 2005.
2005, so almost 20 years.
Yeah.
That's huge. Congratulations.
I launched it with nothing. I mean, I didn't, I was working for a shop and they were cutting back and I was the last hire and I was let go, and I had just purchased tuition for prep school for my oldest kid, and, just spent a bunch of money that, and then suddenly I had to figure out what I was going to do next. So I started this with an idea in my head. When you start these things, then you almost become your family member, right? Because you start them with nothing and you have a lot of pride in them because you start them out of an idea in your head. And, what's wonderful now is once, I reach 102 years old or something, I'm going to be able to pass this business on to my son, Jack, who's working behind me. And the business and the idea and the family business will outlive me, which is really exciting to me.
Here's hoping, right? So I'm curious because just recently, right, in the last couple of years, you've added a money management arm to that business, right? It was sort of research, then you added money management capabilities. I'm curious what that transition has been like for you. Are you looking at the markets differently? Has that changed your process at all, or has it been sort of a natural extension of doing the technical analysis that you've been doing for decades and decades? Was there a difference between putting money behind some of these ideas directly versus reviewing the charts and analyzing them? I'm curious.
Great question. As I've probably the last 5 to 10 years have become a lot more quantitative. I trade all of my own models from my own account, so I understand real time what it feels like and what it looks like and how we do. And I've had people asking me for 20 years, do you manage money? And I kept saying, no, we don't manage money. We're just a research shop. And so being the brilliant man that I am, after about the 1,000th time that I was asked, I discovered that, there may be a business opportunity here. And the great thing about it is since we're everything is quantitatively driven. There's no, this looks pretty good, and the economy's better, and we think this guy's going to win the election. We don't do any of that stuff here. It's quantitatively driven. It's numbers driven. So the secret to this business is, I think, swinging the club the same way, to use a golf kind of a metaphor. But you can't. The emotional pressures on you in this business are so great. To me, the way that I offset that is doing everything mechanically. Everything is back tested and everything is mechanical. It's based on numbers. So it was such a natural fit for me to so we've got, Jack and I have built a number of models. We've actually put those models, we've created 4 different model portfolios using those models in different portions and bringing in different kinds of ETFs, fixed income ETFs and stuff of that nature. They're on our website under asset management. There's a spot there up the top, but everything is mechanical. So bottom line is it was so easy for us to transition to this because it's numbers driven. There's no additional pressure on me, whether I'm trading $1 million or $100 million, because nobody knows what the future is. Yeah. But if you responsibly backtest your ideas, you can get a pretty good idea of what the extremes, during that period might be. So you know what to expect. And then pulling the trigger becomes much easier because you've already done the homework that was involved in that. If that makes sense. It was a very easy, natural move towards doing, starting to manage money and not just doing research.
No, that's great perspective, John. I appreciate it and congratulate you on that new sort of dimension to Asbury Research. Wish you much success for sure. If people want to learn more about you, John, and Asbury Research, where can we point them? AsburyResearch.com is our website. There's a contact tab there up on the right if you want to ask. Get any information about what we do. We have a premium research service. We have a Substack, and we also are managing money for both individuals and money managers. So we do a lot of different stuff. It was good to see you again, John. Thanks for sharing some perspective. Great to meet the next generation of Asbury Research with your son, Jack. So thanks, Jack, for keeping John in line. And we'll hope to talk to you again soon, all right? You will. Thanks. Great to be here. It was a lot of fun to sit down with John Kosar, also to meet his son, Jack. I've heard about Jack and the ways he's been helping John here in recent years. And it was really a good opportunity to chat with Jack off camera as well. Wish them both, of course, the very best with Asbury Research. I really enjoyed John's comments on a number of issues. His discussion about the Asbury Six model, how he designed that model, and how he follows the signals, I thought were really interesting. His work and others really were certainly probably what inspired me to create my own market trend model, though it's not nearly as robust as his. But just having a model running in the background that you can always refer to. I always found John's work along those lines was excellent, and a model to be based off of. I really appreciated his comments about thinking about the strength in technology, looking at the software space in particular, talking about what ETFs to actually select. I thought that was a great sort of window into a successful investor and how they actually go from a top-down to a more actionable specific idea within a space. And again, having spent some time working with and working for money managers and also spending a lot of my time just talking about charts, I thought John's comments in the end about the challenges of money management, I thought, and just how to apply the technical toolkit in that realm were really well informed and well described. That was a conversation with John Kosar of Asbury Research, and appreciate John so much and his son Jack giving me some time here earlier this week. As a reminder, if this sort of conversation inspires you to dig into your own investment process, if you find yourself looking for help in applying some of the technical tools and concepts that we discussed in the episode today, maybe our free course on behavioral investing could be a great next step. I always tell people this free course that I designed a while back, which you can find at marketmisbehavior.com/free course. I designed that to help you think about how you think about the markets. And having talked to hundreds of investors that have gone through this free course before, they always tell me they come out a little different, and hopefully in a very good way, but sort of challenges some of those bad habits you probably have found creeping into your process over time. Hopefully I can help you unwind those a bit. For Market Misbehavior, I'm Dave Keller. Thanks so much for joining me on today's podcast. If you have other ideas of who we should sit down with as part of this podcast series, make sure you drop a comment wherever you're watching this. I'll certainly follow those and take your suggestions to heart. Remember, as I like to finish all of my episodes, it's always a good time to own good charts.